my role in the fund is as co-portfolio manager together with Sam Moss. So the two of us are responsible for all investment decisions related to the fund. My background is the classical Fidelity portfolio manager background, where I started off rotating through different sectors as an analyst, covered tech and industrials, and then after a while became co-portfolio manager, and then started working with Sam on this fund around 4 years ago. Our investment objectives are somewhat humble. We aim to outperform 1 to 2% above the benchmark post fees. And while it doesn't sound like a lot, that compounded over 5-10 years actually leads to some pretty healthy outperformance. And more importantly, one of our key investment objectives is downside protection. So we aim to deliver that 1 to 2% over time while limiting the drawdowns that any investor may see in a 3 to 5 year period. So our investment process is really predicated on looking for stocks that consistently grow their dividends year after year after year. And for us, what's important is not just the level of dividend. It doesn't necessarily need to be a 5, 6, 7% dividend yield, but it needs to have dividend growth. So in two-word summary, I would say dividend growth is the real focus of our fund. Sure. So our typical holding period is around 3 to 5 years. That gives us the amount of time that we feel is needed for us really to deliver what we consider to be our alpha of long-term investors. And where we get the ideas from is, I would say, around 80% from the Fidelity analyst team. Sam and I were both Fidelity analysts, and we realized what a really crucial resource that is. So, Fidelity analysts tapping us on the shoulder, sending us an email, could be more formal, could be less formal, saying, here's the idea, will be the majority of the cases where we get it from. And then the other 20% could be, from other sources, sell-side, investment banks, maybe company meetings where a competitor speaks very positively about another company, or that kind of, wide range of alternative options. Yeah, as we discussed, we really have a key focus on downside protection in our fund. Making sure that, in any given year, we're not materially underperforming a market, and even more important than that we're not materially underperforming a down market. So really focusing on capital preservation as one of our key tenets. And the way that we do that is, we tend to position the fund somewhat defensively, so beta less than 1. And we spend a lot more time focusing on, how much further can earnings fall, how much further can multiples fall, how much further can share prices fall. So really thinking about things with a capital preservation mindset rather than can they double, triple over the next 6 months. The implication of that being that we tend to do best in falling markets. So, markets like early days of COVID, after the Russian invasion, or these kind of markets where in a risk of panic type situation, our fund tends to hold up really well. The flip side of that, when you have a very euphoric, kind of rapidly increasing market, like after the COVID vaccine, for example, tends to be where we'll struggle to kind of keep up with that pace. So in summary, I would say, down markets is where we do our best. Flat to kind of steadily going up, we tend to do okay. And then really in a rapidly increasing market is the one that we'll struggle to keep up the most with.